The first time I have ever gone live on a Friday night. My wife has my 3 kids out to the movies. They went and are watching some special presentation of the Polar Express, which is going to be really fun. But I am able to go live now until they get home. So one of the things I thought I was going to do is hop on here and do a session responding to comments from people that follow the videos and comment on the videos. And I thought it would be fun to hop on, go live, give people a chance. If you have any questions and you want to engage here, I'm happy to answer questions live here as well. I got myself some kombucha, and I figured it would just be a nice, easy, low-key Friday night because that's what a nerd I am. On Friday nights, I go and I respond to questions about whole life and IUL, and that's that. Now, yeah, I guess that, let me just do this. I'm going to get my my screen set up and we are going to get ready. I'm going to, I'll go in here and I'll open my studio and I will get going for the ability to share comments. So here we go. Let me see if I can zoom in. Control plus, I think will work. Let's do that. That way everybody can see a little better. There we go. Fun stuff. If you have any comments, want to ask anything, let's get into it. So, all right. So I did this video on Doug Andrews. Somebody thought it was funny. I don't know what's so funny, but I don't think it's funny at all. Do I think IUL is a good starter policy because of its flexibility? The answer is no. I don't think IUL is a good starter policy because of the flexibility. I think whole life insurance offers a lot of flexibility as well, and I think the fact that whole life insurance, when designed properly, will provide not quite as much flexibility as an IUL, but it's flexibility that won't get you into trouble. A lot of times with IUL, the flexibility that they tout as being the greatest element of the policy is actually the thing that gets you in the most trouble quicker. At the end of the day, as well, I guess my bottom line is I have a playlist that you can find if you want to see it. Actually, I'll go here and I will find it for you and I'll put it in the chats because I think it's really important to understand this stuff. You gotta really understand, I think, this stuff inside and out. But I have a playlist that kind of explains index universal life on a pretty deep level, and that is the end, so you can watch it, and there you go. That is the playlist. If you want to go check it out, I would say after this is over, go check it out. And before you do anything with an IUL, I would watch some videos on that way you have more clarity on what's what. So hopefully that helps. All right, so now I'm going to get back to the comments here, and all right. So I did a video the other day. The video the other day was buy term and invested difference could destroy your retirement plan. And the whole concept of the video, just to kind of give you a synopsis, and I would encourage you to go watch it if you haven't watched it yet, but the whole synopsis was the idea that you can never really self-insure, because the idea behind buying term and invested difference is once you hit a certain stage of life, you don't need life insurance and you can self-insure, quote unquote. But the mindset of buy term and invested difference is missing the concept of the different elements and benefits that whole life insurance brings to the table, like the ability to be a bond alternative in retirement, to be a volatility buffer in retirement, to give you the living benefits riders in retirement. If you become critically, chronically, or terminally ill, you have access to the death benefit while you're alive for medical uses, right? And so this person was saying, why not buy term and invested difference for 20 to 30 years, then assuming you're insurable, which is a big assumption, right? Like you're adding risk in, just the nature of the comment is adding risk into assuming you're insurable 20 to 30 years from now. Why not move that money into a whole life policy or an annuity? Because first of all, the life insurance cost at that point in time is going to be much more expensive. I do agree with the idea of if you do have money that you invested, because I think it's not an either or conversation. I don't think you could just put money into a whole life insurance policy your entire life and then hopefully, and think you're going to get to where you need to go. I think what you need to realize is you need to do both. Whole life insurance is not an investment, folks. It's a savings alternative, right? So we can't compare it to an investment on its own. We have to be comparing it to savings alternatives, and that is the power of whole life insurance. It's a savings alternative that's going to give you all these other benefits. So he's saying, all right, roll it into a whole life policy. Okay, it's going to be more expensive for whole life. It's going to be more expensive for long-term care at that time. I would say any investment that you've made in qualified accounts or anything, rolling that over into a guaranteed income annuity, or like a fixed index annuity that has great income riders attached to it, could be a really amazing way to go. But once again, the annuities are not going to solve some of the problems that most people have. How liquid is whole life insurance as a savings vehicle? That's a great question. What's up, Chad? So I'm gonna just pull up a. I gotta find on here. I got too many slides here. I gotta find the slide that has some illustrations that I could just share. Share an illustration. I think this one's gonna be sufficient. Let me see if it is. Yeah, that one's good. That one's good. It's not, this isn't even optimized, but it's going to be good enough. So why don't I do this? I'm producing my own show here, folks. So bear with me as I get used to hitting buttons. All right. So let's do that. Get you over here. All right. So if we go here, what we're looking at, I just got to erase some of this stuff because this is just something I use for a different video. So just bear with me. But if you look at this, you see you got $10,000 in premium. You have net cash value of $7,370. So do you lose liquidity? Yeah, you lose about $2,500, maybe $2,600 in liquidity is what you lose liquidity year one. But as an emergency fund, you pick up other benefits to go along with it. Plus, you're picking up tax advantages. The money's going to grow tax deferred. You're going to have tax-free access. Whereas in a savings account, it's going to grow at a lower rate from a long-term basis. And then here you go. You can look by year 10 in this scenario, and this is not even an optimized policy. This is more, this policy was designed for something else altogether. But I could show you how it gets even better than this. But at year 10, you put $100,000 in, you got $106,000. So it's a great savings alternative. It's completely liquid. Look at all the extra life insurance that you have. And as time goes on, the life insurance keeps increasing. The cash value keeps increasing at a better rate. All the while, this is guaranteed. So it gives you bond-like returns, muni-like tax treatment, and money market-like liquidity. That is the key to whole life insurance when done properly, right? What's one good thing I could say about IUL? I sell them and clearly am a whole life believer. So you sell IUL. This is Travis. You sell Index Universal Life. I guess my question would be, what do you know and believe about Index Universal Life? And I would say don't sell something until you get to the stance that you can explain it on a really, really deep level. That would be my first thing. I guess my second thing, what does an IUL actually work for? If you overfund an IUL, like really overfund it, and when I say overfund, I'm not talking about target premium. I'm talking about overfunding the target premium right up to the guideline level premium, and you want to utilize that policy for the purposes of retirement income, it's not going to work. You're going to run into problems, and I've got a lot of videos, and go watch that playlist that will show you that retirement income from an IUL perspective is not going to work the way that you think it's going to work. If you want to overfund a policy for the purposes of a permanent death benefit, and that is the main play, if you start young enough, an IUL can work. I would honestly, at the end of the day, I would probably go whole life anyway. But if you planned on never needing to use the cash value, then an IUL, when overfunded, could work. There are also IULs with guarantees that come along with them. There are guaranteed universal life policies from an estate planning perspective, but from a pure IUL perspective, if you start young enough, you fund it to the guideline level premium, and you never plan on taking income out of it, well, then it can work from a permanent death benefit perspective. But it's still like, and what I would encourage you to do is just make sure you're looking at all the columns in the illustration and making sure that it plays out right there. So hopefully that answers your question. All right, let's go to the next question. And so, well, in this one here, you could see that I got into it with this guy. We went back and forth. I answered some of his questions. I thought this one was really important. So this is another one. This guy said, what are the guaranteed values of whole life insurance? Throwing inflation and taxes, is hard to digest this policy as a good savings vehicle. I showed a policy example in this, and it's actually the policy that I'm looking at right here. Whole life is solid in buy-sell agreements, key man policies, and estate planning when large sums of wealth need to be transferred at death. I would never suggest this as a savings plan when high yield savings accounts in a bank are paying impressive yields. Okay, so here's the deal, guys. High yield savings accounts right now are like so overblown, because where was everybody 2 years ago when high yield savings accounts were paying under 1%, right? Like, it's easy to tout high yield savings accounts in today's market, but guess what? As interest rates go back down, so will the performance. You don't solve long-term problems with short-term thinking. And so we have to be planning from a 30-year perspective, not a 1-year perspective. And everybody looks at this like through the lens of like, oh, I can get X amount in a high yield savings account. That's great. Like, come talk to me 3 years ago and talk to me in 10 years from now. And you know what you're going to find is the high yield savings accounts are not going to be performing like they're performing in today's environment. And all the while, whole life is going to be better, or where we are now from a performance perspective. And so when you look at it like that, I think that's important to understand. Let me see here. So I believe in whole life, but it is presented wrong. No, yeah, you're right. Whole life is presented wrong a lot of the time. The average consumer cannot afford 10K per month. I didn't write a 10K per month. I wrote 10K per year. And I would argue that everybody, if you can't afford to save, the average person making $60,000, $70,000 a year can't afford to save $10,000 per year in a policy, then we need to have it. That's even more of a reason for you to click down below on the clarity call and set up a call with somebody on the team to help you with that. All right, so I'm going to get back over here. Somebody just asked questions. So Travis, what's up? Your thoughts on Mass Mutual versus Guardian or Penn Mutual whole life products? Great questions. I try to not get into breaking down products on here because I'm contracted with all of them. And when I say things publicly of one versus the other, they tend to not be happy about that. But here's what I'll say. Mass Mutual is a non-direct recognition company. Guardian and Penn Mutual are both direct recognition companies. Mass Mutual is a good company. They're all really good companies from a financial stability perspective. Penn Mutual right now is going to show the best illustrations. Actually, in fact, Penn Mutual is going to win every illustration battle that you ever see. If you try to design a policy and compete with Penn Mutual on an illustration basis, you are going to lose every time. They illustrate really, really well. It's honestly so well that I don't trust the Penn Mutual illustrations personally. I wouldn't go there personally. Mass Mutual is good. They don't really support banking type policies. They're not a big fan of people taking early policy loans or agents pushing the concept of putting money into a policy only to borrow against it and leverage it. I love cash flow hacking. I love utilizing whole life insurance to leverage a cash value to buy real estate. And therefore I love the idea of being able to utilize it for real estate, and the fact that Mass Mutual doesn't want me to allow my clients to do that kind of ticks me off, quite frankly. I still do use Mass Mutual in a lot of situations for the right people. I don't like the lack of flexibility in the paid up additions on these people. As one of the reasons I like Lafayette and One America, and Lafayette is probably where we do most of our business with. And the reason that is because the paid up additions flexibility, i.e. when we're talking, somebody asked earlier about the flexibility. Actually, I think it was Travis. You know, if I'm trying to find, so Travis, you asked about the flexibility. So whole life insurance can be flexible if you have a policy with the right company and you have the right design of the policy, and you have the right flexibility with the paid up additions from a year-to-year basis. The problem with Mass Mutual, Guardian, and Penn is their paid up additions rider is not very flexible, and their paid up additions rider is expensive. Penn Mutual just raised their paid up additions rider to 15%, which is crazy town to me. And Mass Mutual, I think, is 10%, and Guardian is 11% for one version, and I think even more for the next. I'd have to double check that, but it's crazy. So one of the reasons I like Lafayette and One America is that their paid up additions are super flexible. Lafayette is really flexible with the way they manage their paid up additions. One America has the most flexible paid up additions rider of anybody. The only thing about One America is they won't let you go above they won't let you do a 1090 policy if that's what you're interested in. 2575 is the best they'll let you do, but they have the ultimately most flexible PUA rider in the business, hands down, no questions asked, not debatable. So that's a really, really great thing about One America. The other reason I don't like Mass Mutual and Guardian as much is because their living benefits riders are not as good as One America and Lafayette. I'm just ripping this off by memory, guys. I might miss something, so feel free to keep going on the question. So let's see here. What else? Yeah, but in Lafayette and One America, their paid up additions rider fee is only 6%, not 11, 10, or 15% like the other guys. And so, that's one of the reasons I'm a big believer you need to align with a company that wants to do business the way you want to do it. Lafayette, One America love doing banking type policies. They love allowing policy loans. They love supporting that, all that stuff. And so therefore, I like to do business with them. That's just kind of my jam. I like to do business with companies that want to do business the way I want to do business, and in the way that I want to support and serve my clients, and the people that work with Life 180 and everybody on our team. And that's important, right? Oscar, what's up, man? So, hey, Chris, how are you? Love the content as always. Thank you. Nice new tattoos. Thank you. Has everybody seen them? Check it out. I got to check. Let's see. Oh yeah, I'm wearing a tank top under here. I don't want to but check it out. I got it all done up now. It's pretty fun. And they're all healed finally. So yeah, it's super cool. A lot of fun. They hurt like hell. Took a while to heal. Super deep with the shading and stuff, but yeah, it was super cool. Oh, I forgot my mic was on my jacket. But yeah. So all right, my thoughts on National Life Group's IUL product. Oh my gosh, really? Oscar, why are you doing this to me, man? I don't know if you know this, Oscar, but I used to be the director of business development for National Life Group. And so I have a really sore spot for that company, just based on my experience with them, based on my experience with the people that work there back when I was there. And they are the company that when I was talking to them, they basically said, hey, the reason we're selling so much IUL is because of the fact that we want to shift the risk from the company to the policyholders. That's why we're going away from being a mutual whole life company since 1842, and we're going to start selling IUL and really focusing and doubling down on that. Now, National Life has become literally the #1 as far as sales volume goes IUL company in the country. I think they are trash product. Personally, I would never put, even if you had to put money, if you had to choose and put money into an IUL policy, National Life Group is at the bottom of the barrel as far as quality and all that stuff goes. And so, yeah, that's my thought on them. Team Whole Life all the way. That's really, you just keep getting pitched IULs. I know, man. I'm sorry. It happens. There's a bunch of trolls out there. They just do what they do. So keep the questions coming live, guys, if you want. It's cool. I'm just here until my family gets home. They're at the movies. I'm just chilling out. I figured if I'm going to do some answering the questions, I might as well hop on live and have some fun with y'all. Let's see here. What do we got? Somebody asked if it was whole life or IUL. I did a max cash value. He said, it looks like they're almost identical illustrations and all. So does whole life have an increasing death benefit? So that's an interesting question. Whole life does not have what's called an increasing death benefit. Whole life, though, has the ability, well, here, let me just show you. I have my screen here. I have the ability to show you. So whole life, every single year, they pay a dividend. Well, they're scheduled to pay a dividend. And what happens is you can see that there's no technical increasing death benefit with whole life insurance, but what it is as you get paid the dividend, you can choose to take the dividend as cash. You could choose to have the dividend pay your premium, which would be called like a premium offset, utilizing partial surrender and the dividend to pay your premium. Or you can use the dividend to do what's called paid up additions, PUAs. And there's different ways you can structure these PUAs. But the bottom line is paid up additional insurance is what it stands for, and it's paid up additional permanent insurance. So as you see here, we got $10,000 once again going into the premium, $7,000 net cash value. All the years later, let's go down 10 years, we got $100,000 total in the premium. You can see that the cash value has grown $100,000. The death benefit has grown by more. If you go 339, just simple math, minus 176, we're looking at 3, 2, 13, 6, 1, 163. So the cash value has gone up by 106,000, but the death benefit's actually gone up by about 163,000. And so when we look at this, why is the death benefit actually going up by more than the cash values? Because this person is young enough at 41 to start in the example. And the fact that it's actually buying with the dividends paid up additional insurance, which is buying 1 year chunks of paid up permanent insurance that are fully paid up, meaning there's no additional costs and fees and stuff going forward. That's the power. That's how the policy starts to be on steroids. And you can see the cash value keeps growing, and so does the death benefit, but it doesn't grow like an increasing death benefit in an IUL, because we are actually buying. That's the key here, paid up. That's the one thing people don't understand. It's the one flaw of an IUL is the UL component to them, right? The UL component to an IUL is the universal chassis, which is an annual renewable term feature, which means you can never, ever, ever pay up a policy, meaning there's always going to be fees and charges associated to the cost of insurance inside of the policy, even when you hit retirement, even when you have vanishing premiums. In an IUL, there are still charges and fees of those coming out from behind the scenes, and that is actually what decimates it when you start taking policy loans in retirement in an IUL. That's the problem. With a whole life policy, you can actually pay up, like a lot of these companies, you can actually pay up the policy at 65, meaning when you hit retirement and you want to start taking policy loans, if that's what you want to do, you can do so. And the policy, the insurance charges, all that stuff is 100% paid up. So if you can fully pay it up and there's no charges, that allows your loans to be more effective and efficient and less risk. And that's a huge thing. So IULs as a retirement income product, yeah, it's a joke. It's a joke. My first high cash value whole life was from New York Life. Your thoughts on them? I know you are, as we know, they're a captive agency. Yeah, I mean, New York Life is a fine company. I don't like their culture, the fact that they are captive, and they're starting to allow a little more independence. But at the end of the day, the culture with any of those companies is like, it's kind of that just because you can doesn't mean you should, or doesn't mean it's going to be really culturally accepted for you to go right outside business. They make it a real pain in the butt for you to file and claim that outside business on your U4. And there's all these things that you kind of have to jump through hoops with. That's why I believe in being purely independent and not having to deal with a career company personally. Because New York Life is going to make you get your equities license. When I was with National Life Group, I had all my licenses. I had my supervisory license. I had all that stuff. And I just was like, this is dumb. I just had to get out of it because I didn't want to be involved in the equities side of the business. And because it wasn't in alignment with my values and beliefs, I was like, I've got these licenses and I'm never going to put a dime of my money into mutual funds or investments like stocks or anything like that. So how could I ethically sell them? How could I ethically have a license to supervise people and go train people to go do this? Because proprietarily, that's what Equity Services Incorporated with National Life Group wanted me to do. How could I get behind that? That's the big challenge for me. So I just had to walk away from that, and and it was hard. Anytime you make a big decision like that, it's hard. But I can tell you now, I don't regret it. And I wouldn't change a thing going back. Dallin Bunnell, what's up, man? I just responded to one of the comments that you were, I think, commenting on up here. So if you weren't here yet, check it out. Good comment though. I appreciated the engagement with you there. My thoughts on Ameritus are their Comdex score sucks. There are reasons for that, but like at the end of the day, I'm not a big fan. If a company doesn't have a good Comdex score, I have a problem with that. It's for me, Ameritus has a good guarantee. They pay a 3.75% guarantee, which for this business is pretty good in today's, after the 7702 changes. That's a really good thing. They're one of the bigger companies that we don't sell. And we've looked into it several times. I'm not a fan of them simply because I think they have a 76 Comdex score, and I kind of have a rule that I won't sell a company that has under a 90 Comdex score, because that's just the viability and the health financially of the company. And so if they have a 76, there's a reason. There's always something gone. And I know a lot of people are saying, oh, the only reason they have that is because they didn't pay a third ratings agency, and so they have a lower score. That's kind of bull crap in my opinion, because like if you're a company like Ameritus and every other insurance company is doing it, well then go out and do it. To me, it's just dumb. So that's kind of one of the reasons I don't sell Ameritus. Plus, about 8 years ago, I did sell Ameritus, and they kind of burned me in the way that they treated me. People I know, like Garrett Gunderson, openly admitted he had a problem in an interview with me with Ameritus when he was writing for them back in the day. And so I've heard a lot of problems with the way that they've treated agents over the years in different ways. And I know that regimes change, cultures change, all that stuff. I don't need to deal with it. So the companies that we use are amazing. And so once again, I wouldn't buy an Ameritus policy. And so I'm not going to sell anything I wouldn't buy. That's really what it comes down to, I think. Personally, that's just me. Doesn't mean they're a horrible company. Doesn't mean, anything of that nature. I think on the scale, I'd do an Ameritus. And I'll say this, one of the other reasons I don't like Ameritus is because they sell Index Universal Life openly. And they're like really pushing some of the trashiest IUL out there. They're partnered with Ethos, and they're partnering with FFL now and selling this garbage express issue IUL to people, which is just pathetic in my opinion. It's dangerous. It's bad for the industry. You should never. They're really touting these one call closes with IULs for FFL agents and with Ethos and this express issue crap. It's like it's just insane to me. And to me, that's a cultural thing, right? That tells me if that's where the company's at and that's what they're trying to do, I don't trust them at all. Like even on their whole life insurance policy, that's a problem. So I guess that's my real take on it. IULs are useless with One America's indexing option on whole life. Yeah. Why on earth would anyone buy an IUL when there's a whole life alternative that provides upside potential with the risks, without the risks of an IUL? Yeah. So Matt, what's up, man? That is a great point. There's a couple whole life companies. One America's amazing. Guardian has an indexing option. Guardian has an index option. One America has an index option, and the former Ohio National, which changed names to some new company, has an index option on their whole life. One America's index option to me is by far the best one on the market. It's the cheapest. It's the most true, most pure. If you are interested in the idea of indexing, basically you can take One America's indexing dividend option, and you get the guarantees in the platform of a whole life policy. And then instead of the dividend getting paid to you in the dividend, you let them do an indexing strategy with options, the way they do it with IUL, but they do it with the whole life dividend. So you can actually index the dividend, and it's really, really powerful. Exactly. And so Guardian's expensive, and One America is the best one. Ameritus produces the lowest distributions of any IUL I've ever seen. Yes, Ameritus. You mean from income distributions? Yeah, I mean it doesn't surprise me that's the case. I mean, I know a lot of people that sell Ameritus IUL, and I know that obviously that part of their business is it's a growing part. It's something. My concern is Ameritus is going the way that National Life did, of being a whole life company for generations, and then pivoting to IUL simply because they see the money grab. And as soon as the company starts seeing that they have the ability to focus on IUL and make that a profit center, then that's when the whole life portion of their business starts getting hammered. And all you have to do is look, case in point, to National Life Group and the fact that their dividend right now is like in the 4s. It's really, really trash. And so it's like there's no point to buy a whole life with National Life Group, really, when there are so many better other companies, which is really sad, honestly, because when I first got to National Life in 2009, they were an amazing whole life company. They were one of the best companies in the whole life industry for like literally decades and decades and decades, generations of families. Since 1842, they're one of the oldest mutually held life insurance companies. And now, they've just completely pivoted their business model. And to me, it's just wrong. So yeah, I mean, so Paul Harvey, you're saying, yeah, they're for income. Yeah, I mean, they bad distributions, but once again, illustrations don't matter on IULs, guys. Illustrations are simply unicorn land. If you think an IUL has any chance of performing the way it's illustrated, I've got another thing coming for you. I did this thing called the IUL challenge that was designed to just kind of show people that they're not going to perform the way they're illustrated. I gave people a chance to say, because what do most people say when they sell an IUL? They say, well, this is a really conservative illustration because regulations don't allow us to overhype the performance of the policy in the illustration. Because of regulations, this is a conservative way to do it. And so what I'll say is, I did this challenge called the IUL challenge that I will pay somebody $2,500 if they can show me a policy that has performed the way it was illustrated over the past decade, being the fact that we came through the greatest bull run of all time with a product that promises upside potential and downside protection. If you didn't capture upside potential in the greatest bull run of all time, what the hell are you doing? Like, what's it going to do in the next decade when we're going through what we're going through, and it's going to be even worse? So, it's, I also did a video maybe like 3-4 weeks ago talking about how whole life insurance will actually outperform index universal life over the next decade simply because of the market environment that we're in, and there's nothing anybody can do about it. The IULs are damned if you do and damned if you don't right now. Somebody give me a 2 if you want me to explain why that's the case. Just pop in a bunch of 2s for me if you want me to explain it. If not, I could just keep answering questions, whatever, it doesn't matter. After watching your videos, I felt shameful after selling. Oh man, I'm sorry. Don't feel shameful. You just learn and do better. I sold IULs for 4 years before I realized what I was doing. And I had to have a lot of really hard conversations. Let's see here. Penn Mutual and North American have released recent white paper showing they've averaged just over 8% the last 15 and 20-year period. Yeah, I mean, okay. North American, that's a joke, right? Because North American, I could show policies. I can't do it right now because I have like people's private information on it. But I got a lot of statements from North American, and their cap rates right now on the policies with North American that when they were sold were 14%. Right now, the cap rates on the North American policies are 7.75%. So they're not showing that they actually received that. That might be the crediting rate that they got was an 8% crediting rate that has nothing to do with the actual policy performance. That's the key, okay? We need to look at the actual policy performance, not just the index performance, because that's where people get mixed up with all this, right? It's about way more. I'm a kombucha addict, by the way, if anybody's interested. Anybody here like kombucha? Kombucha is amazing. So good for your gut too. So, all right. What was I going to do? An IMO I work with is about building a team to sell this garbage. Yeah, bro. If you're looking to join a better IMO, give me a call. We're building a big whole life IMO that focuses on training about products and how to sell the right way, not just selling people garbage. Feel free to reach out. We've done other videos on that, but I mean, no harm, no foul. If you don't, it's all good. I wish you the best of luck. But yeah, Paul, thanks, man. Well, thanks, man. That makes me feel good. I'm glad to know that it's doing a difference. All right, so somebody, Paul, you want to see the whole life versus IUL conversation. So let's do this. I'm not prepped for this, and so I'm just going off memory, but and I have one thing that I did that was really, really prepped for this, but let's think about it. So why do I think IULs are gonna underperform? Let me say this. Why do I think whole life insurance is gonna beat IUL over the next decade? Because that's a pretty bold statement, right? Does everybody agree that statement alone on the internet right now would make some people's heads explode, right? The fact that I think whole life is gonna outperform IUL over the next decade. And people go, Chris, you're completely insane for saying that. But I genuinely believe this. And the reason I do is because if you think about it, an IUL, you have to understand what does an IUL do. And I'm not going to go into super detail, but with an IUL, you pay a premium, right? The premium gets paid. And with that premium, a portion of it goes to pay for the cost of insurance and other charges. I'm going to put OC for other charges, right? And a portion of it goes into a cash value column, right? And so then basically what happens is the cash value goes into option. It creates an options budget, the OB, and they go buy call options. And that's ultimately what happens. So what happens here is we have to realize that if you understand this is the flow of money, IULs are screwed going forward in the next decade. Why is that? Because there's a couple. Is it fair to say, let me say this, it's fair to say the market can do one of two things. The market can go up, it can go down, or it can be flat. Anybody else think of any other ways a market can go? I don't think there are. I think that's pretty much it. Oh crap, I got about 10 minutes left and my wife is coming home with the kids. So I'm gonna try to do this. I'm gonna land the plane with this, okay? And so the market could go up, it could be down, it could stay flat. So what do we know about based on options? If we look at the world that we live in, also we have to look at interest rates. If the interest rates keep going up, what happens? Then the market performance goes down. So the actual index will go down. If the interest rate environment continues to go up, that will go down. A lot of people are saying interest rates going up is a really good thing with IUL, because if interest rates go up, then the general fund, the cash value in the general fund will lead to a bigger options budget, which will buy more call options, and it'll be great. But the bottom line is, if interest rates go up, it's going to maybe give them a bigger options budget, and it may lead to increasing cap rates. But if the index goes down because of increasing interest rate environments, then think about what happens. It doesn't matter. You could have a 30% cap rate, but if the market's performing like garbage, it doesn't matter, right? That's what's going to happen. So if interest rates go up, if interest rates go up, then the market is going to perform worse. So it's bad, right? So interest rates up, market performance down. So it doesn't matter what happens with the cap rates. Now, if interest rates down, so if interest rates are down, the market might go up. The market might perform up, but the bottom line is this is going to lead to lower caps and lower upside on the actual thing, because it's going to reduce the general fund, right? Not to mention, because of all the craziness that's going on in the world right now with the government, with the unfunded liabilities, with inflation, with all these things, what's happening is we're getting a lot of market volatility, right? And the more market volatility we have, the bigger the cost of call options gets. And so what we have is, as call options get bigger, that actually puts downward pressure on the cap rates as well, and the performance. And so This is all stuff you have to understand no matter what happens. If interest rates go up, then the market's going to perform worse. But that's just history. That's not my opinion. That's history because it just pulls money. Interest rates going up pulls money out of the economy. That is the functional foundation of Keynesian economics in the flexible fiat currency system that we live in, okay? So as interest rates go up, it pulls money out of the system. That by nature pulls money out of asset classes that will drop the prices of stocks, that will reduce the performance of companies, it will reduce spending, and that's what happens, okay? And so that will have a negative performance on the IUL's actual performance. All the while, whole life will just grow and grow and grow. If interest rates go down, once again, if interest rates go down, that will seem good because the market might perform better, but it will reduce the options budget and the general fund performance. So the general fund performance will go down, reducing the options budget here, right? Which then will lead to a smaller budget to buy call options with, which will then drop cap rates, okay? If the market remains flat, well, then we have stagflation and we're all screwed anyway. And so you might as well come with me, move to the Dominican Republic, invest in the Cashflow hacking fund, and, you know, live on the island near the beach and live a good life. I'll even share my YouTube studio with you down there. So no, I'm just kind of joking, but that is what it is. Just set up a $60K a year whole life policy for your wife. Nice. Love it. I love it. I love it. Penn's a good enough company. I'm not a big fan of the way Penn illustrates. I think it's overhyped, but you can't go wrong with the policy. I don't think your policy is going to perform as well as it was illustrated, but I do believe you're going to be in good shape. Oh crap. Hey guys, hold on one sec. My wife is calling. I'm going to mute myself for 1 second. Just give me a sec. All right, I'm back. Thank you for the patience. So yeah, I got to roll. Any last questions? I got like 5 minutes and then I got to bounce at the most. So any questions about anything? Does that make sense to people? Like for all the, my favorite whole life is Lafayette Life Insurance because they have the most flexible or second most flexible PUA on the market. Their PUA rider is only 6%. Versus Penn Mutual's PUA rider charge is 15%, and the fact that they allow you to front load a lot of money, and you know I don't think they overhype their illustrative performance. I'm licensed, I'm contracted with Lafayette. Our IMO is contracted with Lafayette, One America, Mass, Guardian, and Penn. So we sell all of them, but Lafayette is kind of far and away my favorite. Second place would be One America, then Mass Mutual, Penn Mutual, and Guardian. So, all right. I'm going to try to do it more often. I'm going to do this more often once I get to the Dominican Republic and I'm spending time there. Everybody doesn't know I'm like relocating for partial living accommodations down to the Dominican Republic. I launched a new studio down to the Dominican. Got a new podcast set up. I launched a Cashflow hacking investment fund. It's a private equity fund. Any accredited investors that are interested, reach out. We can have a conversation about it. We got this fund. We're buying a hotel. My wife and I are moving down to kind of like oversee it and manage the operations. And we're revamping it and turning it into a retreat center. And you're going to see my whole studio here. I'm changing it like in January. I'm going to be in the jungle. I'm going to have this one too. I'm going to have this studio too, and I'll be back and forth. But I'm going to have a studio with like literally a 360 degree or 270 degree wraparound glass, 90 feet up, overlooking the jungle canopy and the ocean. It's going to be pretty awesome. If you want to reach out, go to agent.life180.com is the best way. So agent.life180.com. Go right there. If you're interested in having a conversation, just go there. And the person you'll have a conversation with, Travis, is a guy named Matt Seibert. He's a director of agent development for us. He used to work with like a WFG type company and an FFL type company, that kind of IMO, doing IUL for 8 years and had a lot of success. He was multiple six-figure earner over there. And then he came over, we connected, we partnered up, and he really helps a lot on the agent training side there. But we have an amazing online system that teaches. We have live trainings every week, and our focus, if you think I get into good deep stuff here, you come in on the training that we have for the agents on our IMO, and it's like, it's better than this, I think. Well, Chad can tell you, and so can Leads for Locals here. That's Matt. They're both with us, so you could ask them. But yeah, I think we do a pretty good job. And by no means are we perfect, right? Like we're growing, but I think we try hard and our heart's in the right place. And I think that's the most important part of this business, is to be doing it for the right reasons and align with the people that share your values and beliefs and want to do business, that in a way that you think can help people in the right way. So that's it. So, all right, guys. Well, 45 minutes. It's a quick live for me. I usually do like an hour, but I got to go. I got to get dinner ready. Kids are coming home. And I got a big day tomorrow of like soccer tournaments and jiu-jitsu tournaments and all this stuff for my kids. So it's going to be fun. Hope you guys have a great weekend. And hopefully this is valuable. It will process, just so somebody asked if I'd have the replay up. It will process in probably like 5-6 hours. It will be available and ready probably by tomorrow morning. The video will do it, but YouTube will make it. I have my settings on it, so YouTube will make it. Paul, since you're on LinkedIn, the replay of this is always going to be at youtube.com/@life180. That's where it's going to be. I don't have the replays anywhere else. They're only on YouTube. So make sure you watch a replay there. Have an amazing week.